It has been a fascinating first quarter of 2025. We started the year with market consensus heavily favouring a continuation of US economic outperformance, with many headlines and strategy papers bringing the phrase US exceptionalism into common conversation. However, a moderation of this high confidence in the US growth story and concerns over the consequences of tariff policy, alongside an improvement in the perceived prospects of some other regions outside of the US, has led to some significant divergence in the returns of global equity regions. So far, this is to the tune of a 20 percentage points difference between the fall in the MSCI US index and that of the gain from the European market so far this year. Whilst the rotation in fund flow data in recent months has been noteworthy and something we will continue to watch, this is still far too short a time frame to draw any real conclusions. However, the recent period provides evidence for the case of being watchful of market concentration and relative valuations. And so this is a good point in time to catch up with Rothschild Capital Management and the management team responsible for the portfolio of the £2.7 billion market cap RIT Capital Partners. A unique portfolio built on the philosophy of using a flexible, multi-asset approach to ensure diversification. We were delighted to be joined by CEO Maggie Fanari. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989. And provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In today's episode, we were joined by Maggie Fanari, Chief Executive Officer of Rothschild Capital Management, the investment manager of the London-listed investment trust, RIT Capital Partners. Maggie is a chartered accountant by background, but prior to joining Rothschild, was previously Senior Managing Director at Ontario Teachers Pension Plan, where she led the equity division, which had a global mandate to invest in both public and private companies, and also served as a member of many of the pension plan's investment committees. Maggie also served as non-executive director of the board of RIT Capital Partners from 2019 right through to last year, before taking on the CEO role just over a year ago. We are approaching episode 50 of the Investor Insights series, and as we look back, we see a large percentage of portfolio managers we have featured have been responsible for London-listed closed-end investment companies or investment trusts, and we remain strong advocates for this fund structure. RIT Capital Partners, or RIT Cap, ticker RCP, is in our opinion a great example of a strategy using the closed-end fund structure to its advantage, and despite having a history dating back to the early 70s, remains relevant today. The fixed pool structure enables a team to flexibly invest for the long term across asset classes and in both public and private markets, and to make investments which would be unable or would be inappropriate for other collective vehicles. RCP also, however, unfortunately exemplifies some of the challenges faced by the listed investment company sector, which has suffered from a persistent selling pressure in recent years for a multitude of reasons, but causing the shares of this £2.7 billion market cap company to trade on a near 30% discount to the prevailing portfolio valuation, having traded at around a par or small single-digit average premium during the course of the 2010s. We view this as an interesting portfolio, particularly against the backdrop of the market gyrations we are currently experiencing, and we discuss some of the methods the company is using to address the wide discounts later in the conversation. We hope you enjoy the discussion, but as always, please get in touch if you'd like further information on any of the topics discussed. Maggie, good morning. Thank you so much for sparing some time for this. How are you doing today?
Good morning, Gordon. I'm doing great today, and thank you for the opportunity.
No, thank you for joining us. So we have this kind of standard opening question, which I think we've asked everyone that's been on the series. Actually, it is designed really just to get a bit of an insight into you and kind of how you go about your work. Really, I wondered if there was an anecdote from a recent trip that you've been on, or meeting, or current kind of research project that's going on, or even just a book or article. We've had some book recommendations here. Anything you can share just to give us a bit of an insight into you?
Yeah, look, I'll give you both. A book actually that I recently reread is Think Again by Adam Grant. Very much about rethinking, being flexible, and I thought it was really important in the context in this environment where everything seems to be changing. I've also been on a couple of business trips in January and February, and what I found is the mood is oscillating very quickly, and that's creating a lot of noise and some volatility as well. But our job at RIT is really to look past the noise and really have our talented team look around the world for the best ideas and opportunities.
Yeah, no, thank you for that. Yeah, good to have a book recommendation. So thank you for that. Yeah, so I mean, as you just mentioned, really, we're catching you in the middle of a particularly volatile period in markets. This is kind of right bang in the middle of March, and lots going on. I'm not going to ask you to unpick everything from policy coming out of the US at the moment, but I did want to kind of wondered if I could ask you to summarize some of those big kind of primary top down factors that are kind of influencing asset allocation from the team at the moment. I wanted to maybe perhaps a bit later in the conversation go through some of those elements specifically, but any kind of top down kind of summary points that you could give us on kind of how the team are currently viewing markets.
Yeah, I'll give you a couple of points and also just how we've constructed our portfolio. So our portfolio is very much designed for the to think about the long term. So as a result of that, it's diversified by asset classes, by geography. So it's really designed to be resilient in any market environment. So that's the first piece. Clearly, in this environment today, there are geopolitical considerations, macro considerations, and also to the potential for a U.S. slowdown. But from our perspective, 50% of our portfolio is invested outside of the U.S. and are very long-term structural themes. So the portfolio itself has different drivers to capture market growth at different times to ensure that we can compound returns for our investors. And that's what we've really been able to do. So since inception, as an example, our compounded returns are about 10.5%.
Yeah, so lots of flexibility to invest it across asset classes, across geographies. That's very clear. I wondered, as I mentioned just previously, just to give the kind of conversation a bit of structure. You often describe the portfolio in kind of three kind of broad components, I guess. That being the quoted portfolio, the private investments, and then the kind of uncorrelated strategies, or the kind of mix of diversifying strategies, I guess. I wondered if we may kind of go through those three in turn, if I could, and kind of ask you to kind of run us through how the portfolio is currently positioned. So maybe we start with the quoted portfolio. Could you kind of run us through some of those main features, how it differentiates itself from the broader market?
Yeah, absolutely. So if we take our quoted equity portfolio, which is about 45% of our portfolio today, that's really been invested in long-term structural themes for us as a firm. So Japan, China, and healthcare. And it's divided between external specialist managers who tend to focus on these themes because they bring this great expertise, and also the other half is invested in direct stocks. And if we think about the types of managers we're invested in, actually even across our entire portfolio, the majority of which are either cannot be accessed or easily accessed by other investors. And that's what we're really looking to do is give our shareholders the opportunity to invest in a portfolio that can't be easily accessed elsewhere.
And you mentioned that obviously a reasonable part in the US there, but also in other areas, there's kind of notable allocation. If you were to compare it to a broader index, there's notable allocations elsewhere.
Yes, that's right. So about 50% of our portfolio is invested on the public side in the US, and the other 50% is a combination of UK, Europe, and Asia. And by Asia specifically, Japan and China.
Let's move on to the private investments being kind of an area of kind of interest over the last couple of years, particularly for a number of strategies. But it's a kind of differentiating feature of RITCap for sure. It's played an important role over the kind of, if you think of the long history of this trust. Could I ask you to kind of give some examples of current holdings? What perhaps some examples that really exemplify how the team access deals and the kind of value add that you get from this space?
Yes, absolutely. So you're right. So private investments has been a very long-term part of our core strategy. It represents about a third of our portfolio today, and it's very much built on a partnership-driven approach. So we invest in specialist funds, and then we co-invest alongside them. And because we started very early, we're able to identify founders of these funds who we believe are going to do extraordinarily well and pick that next generation of winners. And in some cases, we've been very fortunate to have invested more than a decade ago in the likes of Thrive, which is Josh Kushner's firm, who easily identified Oscar and Instagram and Spotify very early. We've been invested with Iconic. We've also been invested with Green Oaks. Green Oaks had a terrific outcome in a company called Coupang, which is the Amazon of South Korea. We were fortunate to have co-invested in our directs portfolio in that company, which made 7 times our money, and we continue to own that through our public portfolio as well. Again, having compounded substantial returns through the private markets and continuing to do that through the public markets as well. And what we also like to do is to have a degree of concentration in our directs portfolio. So our top 5 positions represent close to 60% of that portfolio, and it's in very mature names and companies like Motive, which is an enterprise software company, and a company I think most would recognize, which is SpaceX, and also to Epic Systems, which is a major healthcare technology player in the US. We're really looking to identify very strong long-term winners who have high free cash flow and significant growth in those businesses.
Yeah, thank you for that. Yeah, SpaceX, one of the recent addition to that portfolio.
Yeah, that's right. And I think it's also important for us to talk about our track record in this space. So in the last decade, we've had a 15% annualized return in our private investments.
I mean, it's fair to say that it's been a more challenging period for kind of private investors in general, kind of across the market. Are you seeing? I mean, in terms of kind of deal flow and the IPO market kind of being closed, how are you sensing things at the moment
Yeah,
out of space?
yeah, no, that's right, Gordon. It has been a challenging couple of years, including for ourselves as well. So, as an example, after 2 years of challenging performance in our privates portfolio in 2024, we're happy to announce positive results and that it's really turned a corner. We were also quite pleased, and this is also bolstered by the new US administration that's focused on a pro-growth business environment and a lot of deregulation, which should spur M&A. So we saw one of the companies in our portfolio owned through one of our fund partners, where we had a substantial position in a company called Service Titan, and that traded extremely well after the IPO. And we were also happy to see the IPO market open up in other parts of the world, including in Hong Kong. So we had another one of our companies held through our funds. Horizon Robotics also IPO and trade very well. And then in January of this year, we had another one of our direct holdings in a company called Zappo, a global crypto storage bank, that we also exited at close to 37% uplift to our December carrying value and about a 2.5 times return on our investment. So what we're seeing is a natural pickup in in the environment. It's really been a steady pace of realizations, and overall, I would say, as an example, last year, we realized about 13% of our privates portfolio.
Yeah, yeah, some good signs there. Let's finish off this kind of segment. Kind of talk about the uncorrelated strategies. I think you call it. I mean, we're quite big advocates of the kind of the role that some alternatives can play in a portfolio. Quite topical at the moment, I guess, with markets um, experiencing some weakness and volatility. But could I ask you to talk through the main elements of kind of this element of your portfolio and kind of the role that you see it playing within the kind of context of the portfolio?
Yes, so with uncorrelated strategies, and that's exactly to your point, it's designed to create that resilience in the portfolio, particularly when you have periods of market volatility. And we own that, and we do that primarily through our credit strategies as well as absolute returning strategies. And there we really look to identify who, in our view, are the best managers in the world, who also give us, because we've built multi-decade relationships with many of these firms and individuals, and we pride ourselves on our access. We get a lot of insights that also helps inform some of our decision making in other parts of the portfolio as well. But that's precisely why we own it, and we maintain about a 24% weighting to that as we think about generating and compounding returns for our investors over a cycle.
Yeah. And could I ask you to maybe just discuss that credit piece as well? I mean, how is that positioned currently? Where you accessing kind of investments there?
So within credit, that's roughly about 10% of our net asset value. And we're generally seeing opportunities in Europe come up a fair amount. I would add that in our case, this is liquid credit. So again, very liquid credit that's generating high single digits with a very high rate of recovery as well. And those are situations that that we like, and we do that with great managers, including one in our portfolio called Tressador.
So the company had annual results early last week, and one of the takeaways, certainly from my perspective anyway, was firstly the kind of the provision of perhaps more insight, transparency into the portfolio, the private investments certainly, but also these updates on enhancing shareholder value, buybacks. There was a notable increase in the dividend, for example. I mean, obviously, the whole London listed investment trust sector has felt a kind of widening of share price discounts, really without exception, but in recent years. But could I ask you maybe just to discuss some of the approaches that the RIT Cap's going through to approach this?
Yeah, no, absolutely. I mean, we when our discount started to widen out about 2 years ago, our board immediately implemented a buyback program, and we continue with that buyback program today. So we've bought slightly more than 8% of our shares over that period, and as long as the discount remains, we will continue to buy back our shares. But what we also think in this environment, which is important, is naturally to deliver on our commitment to shareholders, which is performance of the portfolio. In addition to, we think it's really important to enhance our transparency and our engagement with our shareholders. And we made a lot of investment in that part of our business last year, and we will continue to execute on that going into this year.
Yeah. And given the private e equity element of the portfolio, clearly that has an impact on the ability to kind of realize capital for buybacks. How do you manage that kind of that allocation of capital, I guess?
Yeah. So that's a great question. I mean, we've been able to deliver more than 250 million in buybacks for our shareholders. But going back to our privates portfolio, last year was again the first year which we expect to continue, where our privates portfolio will distribute net cash back into the portfolio, which will also support our ability to make investments and also buyback program, and also the dividend. And as you would have seen, we increased the dividend by 10.3% this this year. But we believe that our privates portfolio, given the maturity of this portfolio, will start to increase the level of the momentum of the level of realizations building on last year and for the next number of years. The majority of our privates portfolio was invested pre 2020.
Yeah, yeah. So getting to that point of maturity and as IPO markets open up, yeah, for sure. And Maggie, we've got a little bit of time here at the end. We have a standard opening question and a standard closing question. The last one kind of looks to ask the speaker to highlight some of their kind of highest conviction areas. I mean, obviously you've got a very diverse portfolio here, but if I was to ask you for some particular themes or even kind of companies or areas of the portfolio that you have particularly high conviction in at the moment, looking at the kind of short to medium term.
Yeah, no, that's helpful. I might put that context in question, especially if in the last 2 years where you had a very strong performance coming out of the United States, largely in U.S. technology stocks. But what we're seeing now is a broadening out of the market, and we think that this is precisely the time for a portfolio like ours that is diversified across asset classes and geographies to really outperform in this market environment. You know, we're quite pleased to have longstanding themes in areas like Japan, China, and healthcare. Half our portfolio is invested outside of the United States. When we think about our privates portfolio, which has a higher percentage of our investments in the US, we look at the current administration and we're already seeing a number of companies filing for IPOs. We know that the environment is improving for M&A in the US. So we see a lot more activity coming through our privates portfolio as well. So we tend to look at the overall portfolio and say this is really the time for diversification, and a portfolio that's really been built for any market environment, but in particular for an environment where you see a lot of volatility.
Yeah, absolutely. Yeah, no, for sure. That's been very clear. Maggie, that's been super helpful, kind of whizzing through the portfolio like that. And I really appreciate your time. Thank you for joining us.
Yeah, thank you, Gordon. Pleasure.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com, for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.